Alright, welcome back. So you are looking at the NASDAQ E-mini futures chart. This is the December contract or the Christmas contract. Today is the 7th October 2025. So I'm going to be looking at what went through for 7th October 2025. So as you can see right in front of you, you have the 7 a.m. delineated on the chart. You have 8 a.m. and the 9:30. So these are my timestamps that I use as references for my trading. So when you're trading, you have to incorporate time and price. If you want to know about that more, you can look into my previous video about the time and price theory. So right here you have 7 a.m. opening up. This is the precession going into 9:30 opening bell. The 7 a.m. opens up, we have the market dropping lower. 7 a.m. opens up, come back into this fair value gap, then we drop to these lows, which is relatively equal lows. This candle's low right here and this candle's low, giving me minus sell side on liquidity. So we drop, coming into the 12 a.m. opening range for today. So 12 a.m. to 12:30 opening range, we trade into that. So I have these. If I am to make these bolder, if I am to make those bolder, you have this range, this yellow box right here, the 12 a.m. to 12:30 opening range. You have the 0.5. Yeah, you have the 0.5 of that range, or half of this yellow box. Then you have the upper quadrant or quarter of this yellow box. So I want you to look at that. I'm going to zoom in right there. Okay, so you have the market putting in a low at the 0.75 or the quarter. 7 a.m. opens up, will rally back higher into the high or the top of that 12 a.m. opening range right there. If I'm to lock this in place, nice like that. So you come back into that top of that range right here where the range starts. Then we drop, going below the 0.75 into these lows. We fail to reach half of the range. Now what does this show? This shows an obvious sign of what? Bullishness. So after we clear this outside liquidity right there, we have the market starting to rally back higher above that. So in this price leg, I'm having something of this formation. If you can look on your right where my cursor is right now, right like that. So I have a low, a high, and a lower low. So I'm expecting a higher high to make me a breaker right here at this high. So I'm marking from this high, as you can see, that candle's high to this low right there, marking my optimal trade entry. If I'm to do something of that sort, show you where I marked. Let me reverse this, just like that. From that candle's high to the low, you have a market coming back and closing above these levels. If I'm to control Z, okay, so the market goes above that, closes, we rally higher, then it drops. So this is your entry for buys, low risk buy. We continue tapping into that, we fail, then we get a low that taps into that. Now when do you know that the move is starting? We fail to drop, we form a low, we form a lower low and another lower low. So this is a bullish 3 drives, 1 2 3. We drop into the 0.618, we'll rally higher, leaving volume imbalance right there and the volume imbalance right there. So I consider that as one PDR. Delineate that into price. I'm having fair value gap with the breaker, so I'm not considering this. I'm considering the premium fair value gap, which is this. I'm matching that to get inversed. The market comes into that, we fail, we drop, we come back into that again, we drop into this volume imbalances. Then this is the market searching for fuel to sponsor this move going high. And as you can see, if I'm to show you my target for this pre-session, I'm having, if you extend back into price, I'm having this high right here. What high is that? This is the New York PM session buy side liquidity. So this was the high that was formed in the PM session after going into the closure of yesterday. Okay, so I'm using that as my target. I'm using that as my target for the pre-market session trading. Now if you are to measure from the move, I expect to take out this low, to take out that high, to that high, you put your quadrants right there. I have that. I'm having the lower quadrant right here, 0.75. I'm having half of that range that I'm expecting the market to move. I'm having the upper quadrant of that, and then that high itself put in. So I want you to look at those levels. So coming back into where we were, this is the 0.25 of that trend that I expect the market to move. The market taps that cleanly, we drop lower. We fail to tap it again, this move is going to take out this low. That's a sign. We come back into this volume imbalance, which has the high of the yellow box, which is the 12 AM to 12:30 opening range. Then we suppose a move going high to inverse this. So this was a bearish fair value gap before. It was worked in, we have, and the bodies are remaining below the lower half of that. Then you have this candle that violates that and closes above it. So I do not expect the market to drop lower again into this. So that's you having your stop loss at break even. So if you had trade 1, you have this as trade 2, this inversion as trade number 3. So that inversion going into that high, we have a fair value gap, a bullish fair value gap. Draw quadrants onto that. I marked this with lines. I didn't want boxes to be many on the chart. Have this as the top and this as the bottom. So I'm having consequent encroachment right there, the 0.5. Market, at what time does it come back into that fair value gap? We rally higher going into half of the expected range to be moved and close above it. So this is an indicator that we are going to continue higher, but at 8 is a new hour candle opening up, and as you know, we have, by default, we need the candle to open. If we have a bullish candle, then drop as manipulation, then we distribute higher. So 8 AM opens up right there, we drop lower, take out these lows into consequent encroachment of that bullish fair value gap, then we'll go back higher into half of the range. We use that as support. Market works on that, suppose a move higher. So you have this as an order block, market drops into that order block, a move higher. So the market, if we are in a buy program, you're going to have the market respecting all bullish PDRs. So I'm having bullish PDRs respected here. We form a fair value gap, the market drops and taps that, then we continue higher, forming a bullish fair value gap. So I'm marking the whole of this because this is a fair value gap on the 3-minute time frame. If you go on the 3-minute time frame, we have that as a bullish fair value gap, and I have a tiny fair value gap on the lower time frame right there and a tiny fair value gap there. So I'm considering the whole of this range. We have this week, if I'm to take off that, we have this week and this week. So this is a balanced price range, a fair value gap above, a fair value gap below. So I'm considering the whole of that as a bullish fair value gap, one fair value gap. We fail to go above the 0.25 of the range, come back into that, stay, the bodies respect the upper quadrant, close above. The moment we close above, I don't expect the market to drop back below that 0.25 level. So we drop onto that again, push price higher, form a fair value gap right there. This is a breakaway gap. I don't expect the market to come back into this because we are running away from this 0.25 level. We continue higher, drop. Now as you can see, now the market is dropping. Before we were staying in the upper part of the fair value gaps. Now the market has the morale to drop below into the lower quadrant. So I'm having the low, and as you can see a measure of that, this drops to a certain level and then this drops more than this dropped. So you can see the bullishness is getting overwhelmed. We continue higher, taking out that New York PM session buy side liquidity. And how far can the market go above this high, the negative 0.25 level? You have that negative 0.25. The market rallies into that. Isn't that clean? Negative 0.25 level. So this is not random. You have to mark this and you have to know market structure. Now going into the 9:30 open, have the market retracing back after taking out this high. Now this initiates a sell move. So if I'm to look at this as a market maker mode, don't take this off. If I'm to look at this as a market maker buy program, I'm going to have I'm going to start at 7. I'm having this as my original consolidation. We come back into that original consolidation. So this is accumulation, rally higher, reaccumulation, going to the target. So this is reaccumulation, go into the target. So if I'm to consider this as market maker buy and sell program, if this is my original consolidation, this right there, I'm going to take off this, going to take off that and these two. So I have that off. Okay, so I'm having this off. Let me make it for you so you can understand. I won't teach the market maker models again after this video. So I have this is a redistribution, reaccumulation. That's a bullish fair value gap. So I'm having this as my original consolidation. If I'm to mark that as, let me make it gray. Will gray work for us? No, I don't think gray will work. Let me have it as this. Let me have it as green. Now this green, this is my original consolidation. So I have something of this sort. This is the sell program. From the original consolidation, we have to come back into the original consolidation. So that's ICT's market maker model. So leaving alone Wyckoff says we have to come back into the range, then we continue higher. So this, I see, that's how they differ, and most of you do not know that and end up misleading yourself saying that ICT took Hypothetical. So this is a buy program right there. We have this as a buy program. Have a buy program on this side, and on this other side I'm having a sell program. So okay, so I'm having a buy program and a sell program. This here we have your low risk buy. When we come back on the original consolidation, this is your low risk buy. have low risk buy right there. When we come back and tap the 12 AM to 12:30 opening range, we have reaccumulation. We have accumulation, reaccumulation. We continue, we accumulate, then going into the target. So we drop lower. You have your low risk sell at this breaker block right there. So this is a bearish breaker. Bearish breaker block right there. This is your low. Let me see. This is your low. That's a bearish breaker. That is your low risk sell. So considering this as my original consolidation for the sell program, we drop lower. We have the market coming back into this. So this is 9:30 opening bell. We come back into the, as you all know, the model that I like most, the optimal trade entry, from this candle's high to this candle's low. I'm considering this because this would be the breaker on the higher time frame. This candle's low. So this candle's high to this candle's low. I'm having my fib levels. I want a closure below that. Then the market coming back into that. The market opens up at 9:30. Have a move high into that. So I'm expecting sells. I'm not looking for buys. So I won't be manipulated into this move. Have this move for rally higher into the 0.618 right there. We drop, we come back into the 0.705, and then we drop. When this low is taken out, I know the move is coming. We come back into that New York PM session buy side liquidity level, and then we have a move lower. So considering this as a consolidation right there, I have my on this side we have accumulation. On the dropping side we have distribution. So we have accumulation, low risk buy, accumulation, reaccumulation going into the buy side liquidity. Then we have a consolidation, we have a low risk sell into this fair value gap right there. If I'm to show you that this is a bearish fair value gap, low risk sell, we continue into this, we drop lower, we leave a fair value gap. A fair value gap is left for what? For redistribution. So I have a bearish fair value gap right there, come back into that, again, but we do not make a higher high than this. So this is a sign of bearishness. And after accumulation, what do I want? Now you can see this was a low risk buy. We have accumulation, reaccumulation. After reaccumulation, I want speed into my target. So my target right here is the 12 AM to 12:30 opening range. So I have to take a screenshot of this. Excuse me. Let me take a screenshot of this, and I wish you can do the same, looking into that. So we have, this is the sweet spot, this fib, we drop, we have the distribution, redistribution, we fail to make a higher high, we do not make any higher highs, we have another bearish fair value gap. As you can see, we are respecting bearish PDRs. Now this is ICT. Let me see. So we have this is the, as you can see, this candles remaining in the lower half of this, not working in that fair value gap like this one. This is the institutional order flow entry drill right there. So as we have the market becoming more heavy going into sales, we have the market lacking the ability to buy into these PDRs, retesting higher into the higher levels of the PDRs. So this is an institutional order flow entry drill. So you would have entered if this was your low risk sell right there. This drop lower, this fair value gap, you do not want the market to come back into this high, so you are already at break even. You would have added in at that. Inside here, institutional order flow entry drill will drop lower. You see candles remain in the lower half. Now this is a bearish fair value gap right there. Institutional order flow entry drill we drop lower into the 12 AM opening range. That's your first target right there. We drop lower. Now for sales, my first target was this, the 12 AM opening range for today. Now I'm having a 12 AM opening range for yesterday below that. Now if I'm to measure the whole move that was moved by the precession right there, I want you to look at the 2 standard deviations. If I tap my expansions, 2 standard deviations, I'm having 1 standard deviation of this whole range that was moved in the precession. How far below that? 1.5 standard deviations. 1.5 standard deviations. Between 1.5 and the negative 2 standard deviations, we have a new weekly opening gap. So these lines you're having here, this is the new weekly opening gap for the current week. It acts as a strong draw on liquidity. Have that, then a drop. Okay.